freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and here is Adam Penn.
Hey, Dustin.
How are you?
I'm good. It's
good to see you.
Yeah, it's a beautiful sunny day out here in California, 70 degrees, and can't really complain.
Must be nice. You've been flying?
Well, I have not been flying a whole lot in the last few days. I was actually thinking about that yesterday when I was driving. I was like, it's clear and blue skies, and I don't know, it's just been busy. We've got projects we're working on. We've got deals we're doing. Me and you are going to Tulsa, and I leave in like 48 hours.
Oh, yeah, you got a red eye.
I have a red eye on Thursday night.
Yeah, very nice. Yeah, I've not got that. My flight's quite early, but yeah, going to visit one of our oil projects, sort of ish, the operator, and see some of the active sites in our most recent fund. Excited about that. Got some investors coming along. It'd be a good time.
Should be fun.
Yeah. Speaking of not really anything that's related to
nothing to do with that.
We got a guest today.
Yeah, we do. His name's Kevin. He's got a pretty interesting background. He's got a lot of companies he runs. Very, he's a fiduciary. He's a financial planner, I think is what I would call him. Although he's very entrepreneurial, right? So he kind of reminds me of like a good CPA, where they don't really act like your typical CPA that just files forms a few times a year. So yeah, I'm excited to have a conversation with him. He runs a company called the Q Companies. So I think it's multiple different companies, but let him kind of dive into a lot of that. But yeah, going to talk about some of the products they have. Going to talk about some of his thoughts around 1031 exchanges. I think he shares a
tax planning,
and I think he shares a pretty similar idea on us on cash flow versus just watching your portfolio grow.
Well, let's dive right into it.
Kevin, thanks so much for joining us today. We're excited to have you on here and chat a little bit. You've got a few different businesses you work on, but why don't you just kind of tell our audience a little bit about yourself and some of your background?
Background, been an entrepreneur my entire life. Built a business in high school, got caught ditching school. Principal wanted to know why. And because it turns out I made more money than she made that year. And she said, now I can see why you're not coming to class. So I enrolled at the junior college, because back then you could transfer classes down. And you could show up to class or not, they didn't care as long as you turned in the work and did your midterm and final. So I graduated high school on a Thursday night, got an associate's degree Friday night, and a week from the following Monday left for the Marine Corps, where I spent 7 years, was a crew chief on helos, was in a crash during training, mechanical failure, and that changed my career very quickly to another direction. But I'd always done stock trading. My grandmother and I were buying penny stocks with money I mowed lawns for when I was 12, buying stock at $22 a throw with the stockbroker. I bought my advisor's practice in 2004 when I came back from 4.5 years of working overseas, and I jumped in both feet. But being an entrepreneur, I approached all this very differently. So my clients were business owners, real estate investors, things like that. John and Mary Jones with a 401k plan, I scare the hell out of them the way I talk,
Mm-hmm.
So I immediately had to get into tax planning. And as you know, financial advisors don't want to talk about that. They'll tell you to do a Roth, but their broker doesn't want them getting you audited, so they're not allowed to talk about it because the broker doesn't want to get sued when, that's the real reason. And so I had to go independent immediately after being licensed, which I'm very glad I've remained independent all these years. I've been a partner at some broker-dealer firms, but I always maintained independence. And getting deep into tax planning changes your whole approach, and you get very focused on income as well. Why do you buy real estate? It's not the rate of return, it's the income. Because it's going to appreciate over time. It's the income, it's the arbitrage on your down payment versus the rental income and the expenses, right? So I've always approached things that way, which makes me not sound like a financial advisor, but you want to talk futures and options and ETF baskets and stuff, we can have deep conversations on that. But I have a money manager that sits in front of 3 screens all day long, that's all he does for all of our clients. So I can work on the 10,000 foot level of things. So we have an entire team of people here. We've developed this out to be something called the Q companies. And it's gone through an evolution over 22 years. And we have tax planning. We have tax attorneys and CPAs that are actually trained in tax planning. Most CPAs are not. And don't bug your CPA about some of these things. It's not fair. It's like bugging your dentist about cardiology. You're talking to the wrong doctor. It doesn't mean he's a bad dentist, It's no. Sometimes it's not fair to bug him about these things. And if you're not going to pay him for their time to do the due diligence, he's just going to tell you no. And so we get deep into all of that. And I learned very quickly, if you beat the S&P every year, which isn't that hard as you gentlemen know, your advisor says you can't beat the market, you need a new advisor. So, and you cut their taxes in half every year. The clients never leave.
I think the taxes are a huge item that so many people just mark off as a bill that they have to pay and never think about what it could compound to if they were able to reinvest that and not pay such a huge bill.
So CPA says, no, it's better to pay the tax. We don't want to get audited. Well, I got a couple questions. One, what are the chances of being audited? 3%. What are the odds we're going to win the audit? 100%. What's the cost of an audit? About $5,000. So I'm going to spend $40,000 a year to avoid a $5,000 audit that I know I can win. I mean, give me those odds. Let me go to Vegas and be a billionaire by Friday. Bankrupt the town. I mean, why? Well, Mr. CPA, what is it you're afraid that they're going to find when they get into your work product here? Is that what's happening? You don't want them to look at, you start asking other questions very quickly. So rule number one here at Q companies, we never avoid the audit. We welcome the audit. We want to save that money up front. Now, we don't go into gray areas. You come to me with some kooky thing you want to do. No, I don't want to get involved in those things. But with proper planning, being very thoughtful, you can stay at an effective 10% rate.
Yeah.
You really can. Now, we'll get our clients to a 0 for a year or 2 years, and then they'll pop up into the 10, 15% effective rate for a while. Usually the juice isn't worth the squeeze to stay in 0 too long. So we're pragmatic about it.
I had a mentor one time, I think it's a joke he likes to tell from stage, but it's, who wants to pay the least amount of tax in this room? And everyone raises their hand. And it's like, you don't want to pay the least, you want to pay the least marginal tax, right? You want to pay the biggest check you can on the lowest marginal rate because it means you're making the most. So I think it's important to focus on that marginal rate.
I want a client to be in the highest marginal rate there is. That means you're making money. I want you to be in the lowest effective rate. That's what you actually pay, right?
Mm-hmm.
That's what matters. It doesn't matter your margin of management is effective. And if you're a W-2, it's tough.
Yeah.
It's tough. Now, we have tax planning for W-2. We have pools of solar credits and all kinds of stuff that we can use.
I think that would actually be a pretty interesting thing to cover because so often we hear there's nothing you can do really if you're a W-2. Right? Real estate professional status is hard to get and so on and so forth. Do you want to just talk, and it doesn't have to be tax advice, but do you want to touch on a few ideas that you guys use?
Most of our ideas for like W-2 people require them to spend a little to get a lot.
Mm-hmm.
So, for example, we have a real estate investment that $1 in can take $5 off your federal the following April.
Yeah.
But then you have to start running this LLC. So you get a little part-time job there, but it's worth it because then you start getting rental income in year 2 from the LLC. So that one works very well. It involves tiny homes and it's working very well. Now there's more than one company out there doing it. A couple of them I've looked at. I wouldn't give them my money, but we have 2 that I really like that run very well. And I started doing this a couple of years ago, and the clients are already calling back saying, now I got all this rental income coming in. What do I do with that? Well, that's a nice problem to have. Well, do something else, right? But you're going to have to, if you're W-2, you're going to have to do something like that. And you're going to spend $1, but your taxes go down the following year. And then we start doing other things. Now, once you have that LLC, you can start running other expenses through it, things like that. But you're going to have to do something outside the W-2 generally. Because if you're W-2, you've only got a couple of things you can do. And one is maximize your 401k plan. And I'm not against 401k. You just better get in there and manage the account yourself, right? Most of them are pretty low fee now. Most of them. So there's not a lot you can do if you're W-2. So we have programs for that. Now, if you're a business owner, there's a whole batch of stuff we can do. We have everything from R&D credits to solar credits to it's harder to get some of the easements, and those got attacked by the IRS, but the guy we was using, he died. He got COVID and died. The guy I was using, we never had a problem ever. And the IRS liked him. They actually would refer to him to somebody who does it correctly.
That's why they got him with that COVID virus.
Yeah, they got him with COVID virus. No, he had some health issues and a heart condition anyway. And when he got COVID, it was just too much for his heart. So I miss him. He's a good guy, really good guy. But he was one of those programs that actually followed the rules, and if you're W-2, we're going to have to go outside. You're going to have to do some other things. But if you're high enough earning W-2, it's worth it. It's well worth it. It's going to require some involvement. Business owners are easier. Real estate investors are easier.
When I'm talking to W-2s and they don't want to put that little bit of extra work in and go, I'm already busy. I ask them to do the calculation on if you did this and you saved that much tax based off of this many hours, is it more than you get paid per hour at your job? And I'm like, oh, whoa, that's a big hourly wage.
What I find as a financial advisor, W-2 clients don't have the entrepreneur mindset. And they're great folks, but they don't think exchange of value. They think exchange of time. And you got to get them to change their mindset a little bit. I'm always giving books to clients. I'm on Amazon sending books to clients all the time. And I have a whole group of books here I ask people to read, and I'll give a picture of this to people. And, there's The Intelligent Investor and Think and Grow Rich and everything by Og Magdino. You got to read these things. The Richest Man in Babylon, right? So As a Man Thinketh, that's one most folks don't think much about. And this is the Bible. And then here is the Constitution and the selected writings of the founding fathers and Thomas Paine and all that, So you want to inspire them to do some reading, or you can read my book. That should help you out.
I like how you keep that on the bottom shelf.
No, there's a whole stack of them down there because I stick them in envelopes that are pre-stamped and pre-weighed. I just got to write the address on it and I stick it in the mailbox. So there's a bunch of envelopes there that are all ready to go. They just need the address.
If we can get a picture of that after this, we'll take all of those and put them in the show notes so that people can have those links. That would be
happy
great.
to do that. Yeah.
I think that's a good transition because I think you probably have a different mindset than a lot of financial planners out there where you look more at, I think you said this in your intro, you look more at cash flow than value of the portfolio, right?
Yeah.
Do you want to talk about that a little bit and your mindset?
When I first started, I backed into financial advisory a little bit differently. They were training us, and this instructor was on the board doing averages and stuff like that. And I got up with my HP4 and I started doing the calculations, and I erased his math and corrected it and sat down. And I'm the oldest guy in the room. See, I changed careers in my late 30s. So I'm the oldest guy in the room, all these kids fresh out of college and stuff. And the old guy looks at me and gets upset. I go, what's that? I go, that's the actual rate of return. You were using a mean average. Mean average is worthless when you're calculating for income. Well, we're just talking about average. No, retirement's about income. How much income am I going to get? And you have to invest for income. You're not saving anymore. You're not building up your nest egg. You're now consuming it. So I put a couple formulas up there for him that actuaries use to calculate a portfolio for income inside an annuity to know that the annuity will never run out of money, right? And those are good formulas to use on any portfolio, right? So the guy gets mad, storms into the partners. And I follow him in there, and he's yelling at them, get that guy the hell out of my class. And the two partners looked at me and looked at him and says, he bought 1/3 of the firm the day he joined. He's a partner. We can't kick him out. So the guy, rather than fix his lesson plan, says, well, this is the last class I'm going to teach for this firm. And at the end of the day, he stormed out. And rather than correct his lesson plan, but I learned pretty quickly, the security broker dealer firms and stuff want you selling certain investments. And if you back into the math like I was showing him, you'd never buy those investments. The purpose of retiring is replacing your income. Will those assets replace your income? And the other thing they don't want to consider on traditional investments is something called sequence of returns risk. You can have a beautiful mean average, but if there's too much volatility in there, you see, if the market's down, your electric bill still shows up. Your electric bill doesn't adjust. Your car insurance doesn't adjust based on the market. So now if your portfolio's down, you're still taking money out because you got bills to pay. Now you don't have enough principal to make a recovery. So the mean average doesn't matter. Also, if you have bigger years in the beginning and lower years in the end, your account balance is very different than if you have lower years in the end and bigger years, later. Now the mean average is the same, but the account balance is very different.
Mm-hmm.
So nobody addresses these things because it's too difficult and it's not, they can't sell you what they want to sell you. So the investments I would choose for clients and the way we would choose and the tax planning we would do, and we treat taxes as an expense like any other expense. How much do you net after taxes? That's what you get to spend. That's what you buy Christmas for the grandkids with, right? That's what determines whether you go to San Diego on vacation or Tahiti. All right. So San Diego's okay, but I'd rather, go to an island somewhere, right? So when you start investing for cash flow, you invest very, very differently and you choose different investments. And I took a 1971 E.F. Hutton training manual. And E.F. Hutton was legendary. He was the top stockbroker for 30 years in the nation, bar none. He and Warren Buffett's careers overlapped, and Buffett never beat him during those years. It wasn't that he was better at picking stocks. He made arrangements so you never had to sell in a down market. He would put enough money in an annuity to make sure the client had what he called mailbox money every month to cover all their expenses. Then he would invest in a stock portfolio that was highly managed. So he didn't have to book a loss. If it's down, if you don't sell, there's no loss until it comes back, right? And by using those two instruments, one for income, one for growth, harvesting the gain when it's there, in a simple 5 pages of this old training manual. So I ran the numbers, and this is 2004. So I'm reading this old training manual that my grandfather's advisor had given me because he'd worked for Hutton back then. And I'm like, why are they not doing this now? In fact, what I learned was the financial instruments we use today are more efficient and the markets are more efficient than they were in 71. That strategy works better today than it did then. So I wrote a white paper on it, gave it to the partners and the parent broker dealer we were signed with, and they said, this is not an approved strategy. You're not allowed to do it. And we had a bunch of arguments about it. Why? And finally, they said, if you do that, we make half as much money per client. It's not approved. Oh. And that was my lesson for how financial services actually works.
Yeah.
Behind the scenes. And that's the problem. So it's not your advisor sitting across the dining room table meeting with you. He's doing or she's doing the best they can with the tool chest they've been provided by the person that holds their license. So I went independent. I left the firm. Took a long time to get my money out of them that I'd paid them. It was a small firm. They don't exist anymore. And I remained independent ever since. And that way, it's between me, the client, the SEC, the state, and what's legal. But I don't have a broker. We use brokers, but they provide services to us. I can fire them tomorrow and hire somebody else. So I turned the tables on it. But I was in a financial position that most advisors, none of those other kids in the room fresh out of college, could afford to do what I did. I had the finances to set up a firm and do all that.
And those kids straight out of college may not have even known. I got a finance degree, and you're sort of told that things are a certain way, like through the training, it's all presented a certain way, and it's just like the alternatives are like a different way of looking at things. Is not even like really presented, right? It's like, here's the universe that you need to know. Now go and like do this thing. And yet it's only like a tiny sliver of like what's actually out there and what makes sense. Not to mention the perverse incentives of everyone else for trying, the larger broker organization trying to sell specific products, right? Like then you get introduced to that. So I think you get kids, like people tend to over-index in my experience on the credentials or whatever else, thinking that means that this some level of expertise, and obviously there's something there, but they don't recognize that those people likely only know a tiny sliver of what's actually available to help clients.
Unfortunately, I've learned in this industry that having letters after your name just means you passed a test, and you were. It doesn't denote that they're truly competent. CFP doesn't mean much. It really doesn't.
Yeah.
It's an indication that they've studied more than other folks. CPA doesn't mean as much as you think. They passed a test in 1981, and they watch 40 hours worth of videos once a year while they're doing something else, right? And that's their continuing education. Then I'll have other CPAs that are just genius. So you've really got to meet with the person and dig deeper. But it is an industry that is not focused on you. It really isn't. I mean, a broker supervising an advisor is supposed to be there to make sure the advisors follow the rules and all that kind of stuff, right? That's the excuse for it. The real thing is they want control. They want to control. And they make their money on revenue sharing, and that doesn't have to be disclosed to the client. They're selling that DST because they're getting an 8-point revenue share on the back end, which comes out of your rate of return, which is the reason so many of these DSTs never perform. Some of those DSTs are so bad, you're even better off to pay the tax than 1031 to one of those things. So, and the ones that truly perform aren't eligible for 1031 money. All right. So, one of the things we help with is alternatives for 1031. That's one of our main things. So, when people,
I think that's a good switching point here. So talk about your 1031 product and the installment sales.
my first year in business, a friend of mine told me, he says, "Hey, Kev," I'd known him for many years. "I got this apartment building. It's in a bad area of Inglewood. I don't want it anymore. I inherited it from my dad. I got to step up in basis, but I've depreciated that to zero at this point. I heard about this trust thing that I can do, and it's not the charitable one where you got to give it all away to charity someday. You sell it to the trust and you take income from the trust." He goes, "I can't find the folder. It was from one of the big accounting firms." He goes, "You can figure out how to do that. You can have it. And just send me an income stream. Sell the building, put it in the trust. You can manage it. Just get it. I'm sick of it." Yeah. And the apartment building had been raided. One of the people in one of the apartments was selling drugs, and the cops had been there. So he'd had a fill of it, right? And we found a buyer. The buyer was a guy that specialized in Section 8. And he would buy, rehab, reposition, and he focused on Section 8. And anyways, I found the program. It took a while. I found 2 recently retired tax attorneys from Ernst & Young. They were in Columbus, Ohio, and they stayed business partners. And they were already 80 and 81 when I met them. And they still wanted to work. Accountants and financial advisors and real estate people, we don't ever retire, right? So they taught me the whole program, gave me all the materials, helped me set up the first several of these that I did. And that's how I started going down this road. And through them, I met a tax attorney here in Los Angeles who said, "I'd like to have an advisor in-house here in our office. We'll give you office space. I got a great office right next to the conference room, and you can use our reception. You just just be here. No rent. Just serve our clients. We want you here so we can keep our eye on you because we don't trust you." And he loaded me up with clients. And there were several tax attorneys there, a dozen CPAs, and a bunch of other folks in the firm there. And I got to sit in on audits, and I learned a lot. They educated me a lot, and they loved the program. They still use it. They became a multifamily office. He serves 6 families. That's about $18 billion between those 6 families. He brought in a different guy to replace me later. And when I met the guy, I would have hired him too. I'll admit it. The guy was worthy. The guy really had his stuff. And he had a larger staff than I had to support what Ed was wanting to do. And I still do business with all of them, so we even parted on good terms. They still use my program all the time. So in 2010, a mentor of mine, Lee Brower, told me, he says, "Kevin, your unique value proposition is this installment sale trust. Other than that, you're competing with every other advisor out there, Ken Fisher and everybody else, right? So this is your unique thing about your business. Why don't you lead with that more?" And that's when we pivoted to really, because I was doing 8, 10, 12 a year of these. And that became my focus from 2010 on. And then we eventually set up our own in-house fiduciary trustee service to get the fees down. Because the banks and the other attorney trustee service who we were using, the fee was negotiable for whatever they could get, and I was tired of dealing that way.
I think a lot of listeners probably aren't going to be familiar with what an installment sale trust is. So do you want to walk through kind of what the mechanics are?
It's a form of a business purpose trust with a unique operating agreement. We use the revocable trust version. Other people tell you not to do that because they want you trapped, right? Ours is revocable because if you need to leave, you either have a reason to leave or we're not serving you. So either way, you should be free to go, right? But it's a type of business trust that buys the asset. Then the asset's sold to the final buyer. The cash comes back to the trust. You don't have any constructive receipt. You have a note that controls the trust. That's your control document. You can't be the trustee. That violates arm's length and related party doctrines in the tax code. And there's some other things in the rules that you can't do. But we manage it for what you would pay Wells Fargo to manage an IRA account. Seriously. We've been getting the fees down every year by getting the fingers out of the pie. When I first started doing it, we had to use an outside broker dealer, an RIA firm, and we had to use outside attorneys, and we had to use outside trustee services and stuff. All in, you're about $295 a year. It was still cheaper than paying the taxes, even with the fees, but we've shaved it down towards 1.5 now or less. So we set up this trust. It's very streamlined. We use City National Bank and their trust division for all of it. You have all kinds of controls over your collateral. You can't be the one doing the trading and the investing. That violates arm's length, but it is collateral for your notes. So essentially, you're loaning money to the trust. But the assets in the trust aren't commingled. It's a unique trust, unique investments, unique everything. There's an online portal where you have access to view all the investments, all the statements, everything else. It's all managed. We've made it very autopilot. So we set up this trust that buys the asset. The trust sells it to the final buyer. Money comes back to the trust because the money's got to go somewhere at close of escrow. If it goes to you, it's taxable. If it goes to the trust, it's tax deferred. Then we do tax planning every year to knock the taxes down.
And just slowly pay down that note.
The note probably never gets paid. Your grandchildren will be getting income on that note. Or you can terminate the note and pull the money out and pay the tax at the time you're choosing. It's up to you.
What types of investments do you see? Because, a lot of people that are in real estate investment and probably want to do a 1031 exchange. Does this make sense if they want to go into another real estate deal?
Yes, it does. And the reason is you would have to use our exchange because the IRS approved our trust as part of our exchange. So we actually own an exchange accommodation service. I set that up a few years ago after dealing with several exchange accommodators that their attorneys kept arguing with us. Yeah, the IRS is fine with it. Well, I don't think it's okay. Well, call them then and complain. I told my guys we're going to set up our own 1031 exchange. Well, that's got to be difficult. Have you met some of these people? It can't be too hard. So, I was that tired of it. We set it up in 4 months. IRS approved all of our documents. The installment sale trust as an alternative for the 1031. So it's q-1031.com. You set up an exchange there. So the money goes into the exchange, the accommodation service. If you don't identify in 45 days, it falls back into an installment sale trust that's set up for you, that's included. If you do identify and don't close in 180 days, the money falls into an installment sale trust. So you haven't failed. So we give a guaranteed exchange. Now, once the money's in the trust, you can then have the trust join you in the LLCs that you're buying these other investments. So let's say you go buy some apartment building. The trust puts 20% down by funding 20% of the LLC, and it owns 20% of the LLC. You own the other 80%. Now, that new purchase is a fresh purchase. You see, in a 1031, you carry over the old basis to the new property. But what if every purchase was a new purchase and you got to redepreciate all over again? Right?
Mm-hmm.
What if now you could divide that money up between 3 or 4 apartment buildings? I'll just use those as an example. and you're buying them at a time and a date of your choosing on a schedule you chose, not the arbitrary 1031 schedule, under terms you've negotiated, and the trustee just becomes a partner in the LLC you're buying it with. So now you get to take advantage of the other poor SOB who is trying to
Trying to 1031.
trying to 1031, right?
What is just tell me if you don't know the logistics on this, but if you've got, let's just say, this new building, I think most people are going to know their tax consequences for buying the building, but what are the tax consequences inside the trust? How does that portion of that 20% ownership, where does that flow to?
The trust doesn't pay tax. It's all tax deferred in the trust. The trust doesn't pay tax either. The tax is only due when you take a withdrawal from the trust.
What happens to the gains generated inside the trust?
It's all deferred until it's taken out. Kind of like an IRA account. It's not a qualified account, but in theory, it works much the same way. Yeah.
Does that increase the value of the note then, technically?
Yes, actually, good question. So you get a note at a stated interest rate, which is part of the tax code, how it has to be. But then there's a second paragraph that tells you plus appreciation. So you give me $1 million, we're sending you 60,000 a year because the note's always 6%. And it's always 6% net. We have to pay for ourselves. We have to pay for ourselves plus this. And we do, and we can show you how we do that. You say, hey, Kev, you've been doing pretty well. I noticed the trust assets are up to $1.5 million. I go, yeah, what would you like to do? He goes, well, I'd like to refinance my note. I need $100,000 for a new RV. We want the one with the push out. And, we're going to take the grandkids with us. And then I would like 6% on $1.4 million. I says, well, watch your email inbox. Within an hour, you'll have a DocuSign. And voila, you just refinance the note against the trust. The other thing is in the note, because the nature of the note receives a step up in basis that you're passing, just like the real estate. So if you don't want your kids to reach in and pull everything out tax-free and fritter it away, you'd better address that in your estate planning document. So this process can be used to bleed down an estate below estate tax threshold.
This has all been incredibly fascinating. I think I'm like 3 questions in here, and we're like 30-something minutes in. So I'm going to let Dustin go. Dustin, what questions do you have?
I'm kind of like you. I guess this is it's opened my eyes a little bit. I think to the this idea that Adam, you and I see so often that everybody they're focused on 1031s and the time pressure, and you kind of got a gun to your head and to identify and then actually close the transaction. And there's all sorts of other ways people try to get around that, like the reverse 1031 and then the pre-funding sort of thing that some people do. So my head's kind of spinning here, like, okay, this is another tool in the toolbox, so to speak, that I had not been very familiar with.
You don't have to do any of those other gyrations. Let it drop into the trust. If you got a buyer on the hook ready to close, take it. Don't have all these contingencies and you could lose your buyer and everybody's trying to line it up. So he's trying to line up his 1031, you're trying to line up yours, the next guy's trying to line up his, and this guy fails and doop, 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 So no, let it drop into the trust, go shopping. And now you're going to get a fresh purchase. You're going to get to redepreciate everything all over again. You're going to buy at a time and a date of your choosing under terms you've chosen without all those external pressures. Did you know the 45-day and 180-day rule wasn't in the original 1031? People started doing a lot of these, and IRS says, wait a minute, that's too easy. So they came up with these. No, that's IRS. That wasn't in the original law.
It's like their 27.5-year depreciation schedule. I think they just rolled the dice and it landed on the side. And I'm like, 27.5.
No, I kind of joke that the IRS says, well, Congress says you can do it, but we're not going to make it easy. So they're hoping you fail.
Kind of last question I have, I know Dustin will have one more, but is what mistakes do you see people making that you would maybe want to give advice on?
Sometimes they do that 179, the cost seg and stuff like that. And then when you turn around to sell later, that all gets recovered immediately. And that's a difficult thing to offset.
So do you not do?
No. Do it. But do it on a building you're going to keep 20 years. If you think you're going to sell this for $5 million and buy a $10 million building in 5 years, you might not want to do that because then you got to recover all. Because they converted parts of the building to personal property. Nothing wrong with it. It's just being sold for an initial benefit, sometimes not thinking 5 years down the road that I'm going to have this building fully repositioned. So you're going to use that money to do work in the building, right? And all at market rate, and I'm going to sell it off to a REIT or some portfolio. And then I'm going to go buy a $10 million or $15 million building, and then you recover all that, and it's ouch when that happens. And people have come to me telling me what happened. What can you do? Can't. So just remember, the IRS only gives you a deduction if they plan on getting it back later. To them, it's a loan. They think it's a loan that they're going to get back later.
So does the installment trust help you with the depreciation recapture at all?
We have a method that barely skirts being a step transaction to offset most of it. It's right on the edge of the line. Our tax attorneys assure us they could win the audit.
Have you done one yet?
No, but not on that. Not on that.
Yeah.
I have some people at the IRS that I communicate with all the time. I find them to be more reasonable and easier to deal with than the average CPA, by the way. I'll call him with a question. He goes, "Who told you that?" "Well, this CPA was telling me this." And he goes, "No, we're not worried about that." So, why is he so worried about that? No, it's not even on the radar. So, when I talk to them, they're actually pretty reasonable about most of these things. There is a method to keep it from being recovered, but it's right on the edge. It could be called a step transaction, and we would have to defend that. And they wouldn't be necessarily wrong calling it a step transaction if they did. Just don't do that cost seg if you think you're going to sell the building in the next 5 years and try to go to another building, because you can't 1031 that. It's a nice benefit, but we have other ways of getting similar benefits. Another mistake I see is people trying to be too passive with their real estate. Real estate is not as passive of an investment as you think. It really isn't. If you get too lackadaisical with that property manager, they're going to start fudging. I had 43 properties. They were all single family homes here in Southern California. Another thing that they don't do, especially as they get older, because I tend to get clients, my average client's about 60 when I get them. And they really haven't prepared their heirs for what's coming. And the kids are pretty clear. No, the minute you're dead, we're selling all of it.
Yep. That's the thing I've talked about a lot. And I'm younger. I don't even have kids yet, but I don't see how you can build an empire and then just not train the heirs on how to run it.
You don't have kids yet, do you? The old saying, apple doesn't fall far from the tree. No, sometimes it rolls all the way to the bottom of the hill. So, and that's not good or bad. It's not good or bad. I was always very entrepreneurial from my grandparents and my father, both sets of grandfathers and my father. And I grew up totally entrepreneurial, where my oldest brother, he's since passed. He was the perfect employee for any place he worked, got promoted very quickly, did very well in his career. But he was not an entrepreneur. He, just was not an entrepreneur. Give him $20 at breakfast, he's broke by lunch, so. But he was a very responsible person, right? So it just wasn't his thing. So you need to have a conversation with your kids. What's going to happen is you're going to be in a home, Alzheimer's care, and your wife's going to be selling that thing early and paying the tax, pay for your care. You need to think through that process and how this is going to work. And if your kids really are going to sell it all, just sell it now, use an installment sale trust, take the same income from the trust you were getting from the property. Now your spouse has liquidity, so she can afford to put you in a place that doesn't smell like urine, or maybe keep you at home even and have nurses rotating through. I did that with my parents. My dad passed. My mom's finally in a home. She has to be in an actual home. She broke her hip, and it's never going to heal. So she's 93. We have the same conversation every morning for 20 minutes that we had yesterday and the day before. So it is what it is. But it's also $16,000 a month. Stephen Covey said, begin with the end in mind. Or my grandfather with his Swiss accent, think through the steps in the process. He was always saying, I can still hear his voice today, and it irritated me as a kid, but now think through the steps in the process. Everything in life is a process. He was always saying those things. And he programmed me to do that. He made all of us play chess. Not about the game of chess, about learning to think 5 moves ahead, right? Training the brain, right? And so you need to think about, now, some of your kids, it just isn't their thing. It just isn't their thing. Well, then maybe you need to make arrangements so you're not dumping all these assets on unprepared heirs. Maybe it's usually the husband managing things and it's the wife that these things get dumped on. But I have one couple that she was the real estate guru and he was an engineer at Boeing. And he said, I've never balanced a checkbook since the day we got married. I don't even know where the accounts are half the time. I don't care. She hands me, years ago, she used to hand me an envelope once a month. That was my allowance for the month. And he's an engineer. He's a brilliant, brilliant man. And he just didn't want to deal with any of that. And she built up quite a real estate portfolio, mostly fourplexes in Huntington Beach, California, right? And she managed them well. She was a tough property manager. She knew how to get a tenant out, I'll tell you that. So, no, they were sharp, sharp people, but they even divested themselves and used the trust to do that. Because one son's a doctor in Seattle. The other one he's not a CPA, he's another type of accountant, CFO and something else for a firm in Boston. And I forget what the third kid is. And they said, we're selling it all now because the oldest one will want to buy out the other two, but he can't swing it. And this isn't his thing. The middle one will do whatever makes the other two happy. If you have children, you understand what I'm talking about right now. The youngest one wants a new Ferrari. So he says, when you meet my boys, you're going to like the youngest one best. Everybody likes him best. He has the most sanguine personality. And I did. He was great. And none of them were irresponsible. But he just understood it just wasn't their thing. And they were just going to sell it off or fight over it. The oldest one was very studious, so he'd try to manage it all and probably resent the other two for getting a third of the rental income for not doing their part. And I've sat doing estate planning. We do estate planning as well. I've sat at dining room tables with kids fighting with each other thinking they must have been adopted. No way in hell they came from that lovely couple I got to know over all these years. Because first dad passes, usually dad first, then mom, and then I'm with the attorney talking to the kids. And you got to think about these things in advance. Don't set it up in a way that they're going to be fighting at Christmas and Thanksgiving and everything else. Just don't do it. And you know your children. You do. You know their personalities. And it's not going to change once they're a certain age. It is what it is, right? So set it up to where you have a trust that becomes a legacy to make sure nobody ever pays for college or has student loans. There's seed money to start a business, things like that. You can write these rules into the trust. So this installment sale trust goes very easily into different types of family or legacy type planning. And then you can spend your twilight years not managing tenants and toilets. Why are you building this wealth? Why are you buying these apartments? What are you doing? What is the final outcome? What do you want to create?
I think that's actually a really good segue to the question we like to ask all of our guests. It is around, we're the Wealth Independence podcast, and the words, independence and freedom mean a lot to us. And so we like to ask every guest, what do those words mean to you? How do you manifest that in your everyday life? And I feel like you're kind of like touching on a lot of those ideas. So I'm definitely very curious to hear the answer here.
So you're in a position that when life gives you lemons, you can afford to make the lemonade. Okay? You're in a position of choice. It's not to buy Ferraris. It's not to show off. That's superficial bullshit. You want to be in the position that when the grandson comes to you and says, Grandpa, I just got accepted to Harvard, get my MBA. I don't know how I'm going to go. Say, don't worry about it. Go. It's paid for. All right. So you want to be in that position.
I love that. Calling it choice. I would use that same word myself. Choices, having optionality. I think that's huge, and it definitely sounds like the path you're describing there.
I think you've had tons of great comments and advice. What's the best way for people to find you or reach out or get a hold of your company?
For me, kevinbrunner.com. Then you can also go to the Q companies, plural.com. You can get access to my calendar there. You can get right on my calendar. I even have an option to get a 5-minute Q&A appointment. You can set one of those, call and ask me a couple of quick questions. I'll give you the answer and I don't even charge for it. It's a way of paying it forward because so many people have given me advice and didn't ask for anything but a cup of coffee. over the years. I think we have an obligation to do that occasionally ourselves, right?
We'll make sure those links make it into the show release notes so everybody can connect and potentially take advantage of that. I think that's an amazing offer.
Oh, thank you.
Adam, any final questions?
All good here.
All right. Well, Kevin, thank you so much for joining us. It's been a great conversation.
It has, hasn't it? Thank you.
Yeah. I learned some stuff. Like my curiosity's now like spiked. I'm going to have to go do a little bit more research into some of these things.
I think it kind of goes back to what Tom Wheelwright says, right? It's not to change your tax, you have to change your facts. And I think he's pretty good at changing the facts, right? He's not skirting the law. He's not doing all these other things that are, gray areas. I actually think somewhere in that he said, I wouldn't do this. That's right on the line. He obviously knows the rules and wants to follow them, but understands that the rules are a set of rules, right? And you can see you can build a roadmap around them. So I think that was really cool. And I don't know that I need to dig into a whole lot of kind of what he talked about on the financial planning or their products. I mean, some of them I think are really interesting. And I think that we have probably some pretty aligned visions. I mean, that was the longest interview I think we've done. But one of the things that stood out to me was just, he's very big on making sure the experiences are good, right? Not just the experiences of his clients, but like making sure, like what he said about the Eiffel Tower and like the family going on vacation and all of that. I think that's truly what we're all driving towards, right? You're not driving towards a bigger bank account. That doesn't really get you anywhere if you're not going to use it, right? If you're just going to work a 9 to 5 and be upset when you get home and you got, let's just say you have a $10 million portfolio and you just never feel like it's enough, doesn't really get you where you want to go, right? I mean, I think the goal is to kind of have that freedom to go do what you want.
Absolutely. Yeah, I mean, I like this word. I mentioned this when we were recording, but talking about the word choice, right? And I kind of use the word optionality. I think that's big to me, and you can obviously hear that in just the things he talks about, how he talks about them. Of course, I like to talk often about how much I don't like the traditional financial planning community and everything that goes into that. And I think he gave some pretty good points there. And coming into it as an outsider, you mentioned the career change. I think you bring a different perspective. And if it's someone like the way that most people end up in that career, which is kind of the sort of the not that I wanted to do that, but getting a finance degree, undergrad, and like going through that, that's sort of the first step. And it's like I saw that. And then you get someone that doesn't have that like initial training perspective come in from the outside. And it's like, wait a second, why don't we do this? And this would make more sense. And it's like, oh, wait, that doesn't make us money, so we can't do it.
And it's not like he wasn't a rule follower, right? He was a Marine for 7 years.
Exactly. But asking the right questions, right? And challenging this like idea of, well, this is just the way that it is, I think is huge and leads you down a different path. And then you start asking those questions, and then certain people are kind of upset that you're asking those questions. And it's like, okay, well, I'm just going to go do my own thing then and try to provide what's going to be best for the clients. And I actually think it was after we stopped recording, he mentioned the relationship that he has with his clients and talked about that like half the people at his wedding were clients. Mm-hmm. And so I think, when you really like are proving yourself to not just be in like the legal sense a fiduciary, but are actually like going above and beyond to really like treat your clients well, it pays off, right? And not just like, okay, well, we're going to do this thing and we're going to put you in this product because it'll suit what you need, but I get a nice kickback on it too and get, the commissions, things like that.
I mean, there's a partner of ours that has been doing investing for decades, and I hear him frequently say like, all of my investors are probably they're my friends. He's like, every one of them is a friend, and I probably don't have a friend who's not an investor. So we do the deals that we are going to be happy with hanging out with our friends when they're done, right? We don't want to lose someone's money or buy a building just because of that or another thing. And I think that really shows.
And I think very few people can say that about their financial advisor or their money guy, right? As people like to say, like that's just not.
You probably didn't go to his wedding.
Yeah. Yeah. Well, I don't know, Adam, any parting thoughts on this one?
No, I think we're good.
All right. Well, as we mentioned, we'll have all of Kevin's links and everything. You can connect with him and take him up on that free call. It's a neat thing, especially if you got tax questions or something. I think it's a really good resource. But we'll make sure all that's in the release notes, and you can check him out there. And we'll catch everybody on the next episode. If you enjoyed this, as always, give us a like and subscribe on YouTube, a 5-star review on Apple Podcasts, and whatever it is you do on Spotify. We'd appreciate that. Let the computers know that you're enjoying this. We'll get the message out to more people. But we'll call it a wrap with this one. We'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.